let's talk things on the index level. Now, Bloomberg Commodity Index rebalancing for 2026 that is now underway, running from January 9th to 15th. Now, with BCOM's 15% weight cap, overweight commodities like silver, they're now seeing forced technical selling that's estimated at $5 to $7 billion globally. And this is creating short-term volatility and also price pressure, including on silver-linked Indian stocks. And the key question is, how do we see this technical correction playing out versus the underlying fundamentals? Now, to get a perspective on this, let's get talking to Ajay, the MD and Research Head at Kedia Commodities. Hi, Mr. Kedia. Thank you so much for joining us today. And firstly, let's talk about this report that you came out with as far as this index rebalancing is concerned. Now, you did say that $6.8 to $7.1 billion of gold and silver futures, they are expected to see selling from the BCOM rebalancing. Now, is this volatility temporary, or does it help form a durable price flow for long-term investors?
So, Kanisha, slightly confused whether I should say golden afternoon or silvery afternoon, because last year, 2025, was a very fabulous year for commodity, where we have seen 180% gain for silver and around 80% for gold. And it was in line of expectation that rebalancing would be going on, because see, generally this type of asset has allocations vary for long term, and returns could be around 18 to 20%. But 2025 was a benchmark, we can say, or remarkable year. So yes, it was in line of expectation. Generally, the category is 33% for any sector, and let's say 15% for each and single commodity. So the data what suggests gold was around 20.4% allocation, that can come down to the level of 14.9. That means approximately $7 billion dollars should come out from this fund, which is a significantly a big amount. Similar kind of movement will be there in silver also, where the allocation is around 9.6, but I think it should be around 4%. Again, there will be a 7.1 billion sale could be possible. And it was in line of action, because this type of return we have never seen. No doubt our fundamental side is still remain bullish, because we have a supply of, let's say, 1,000 million ounce, whereas the demand side, investment demand in last 3 years was around 200 million ounce. So there was a deficit since last 5 years that has supported the prices, and returns are in front of us. So yes, I do believe some kind of correction, or a time correction at least, in bullion we can see.
Some time correction is definitely what we can see going forward in the bullion. But now let's talk, commodity specific, Mr. Kedia. Now, as gold weight drops from nearly 20% to 15%, like you were highlighting, now is mandatory index selling the key reason for gold slipping below that $4,450 mark? Of course, we have seen a little bit of an uptick from there. But what are the key reasons that you see for here?
I think there is no new reason that why we should sell gold. But frankly, last couple of years, whatever the factor that has been seen is now maturing. Take example, leaving central bank buying, de-dollarization. The term has already been discounted, and already Donald Trump is taking care for this. Dollar index was continuously down, but we have seen July, we have seen the level of 96, and now it's around 99, which is showing a rebound. No doubt the interest rate is going to be more important, because up till now we were expecting only two rate cut, but after the Fed statements, Fed member statement and economical data, maybe there could be a three rate cut of 1.5%, which is again a supporting. But I think everything has been almost discounted. And important trigger would be this ETF ETP investment, because investors are slightly more we can say volatility. Whenever they get any other opportunity, they shift. So I think the high possibility of profit booking can be seen in gold, but we don't expect a crash-like situation, but a correction of, let's say in the October month, we have seen 13% correction to the tune of 22% is not a big deal for gold, with getting a gain by 80%. So be ready, like profit booking would be there, but the fundamental has already been matured. But let's see till how long geopolitical tension will carry on in 2026 will be more important.
Okay, so we'll keep watching for those geopolitical uncertainties that we have been tracking all through the past year, and all of that led to a price hike in terms of gold as well as silver. But Mr. Kedia, like you were highlighting, the Fed rate cut, those are going to be some of the key factors that we must watch out for. Today evening, the jobs data is going to be out, and we should have some clarity on where the rate cuts could be headed. Just wanted to get a view on price targets, if any, if you could give us a quick one here.
I think we are not looking for a short-like position, but we are advising our client not to take bigger long position as of now, because there are two, three things. One is the job data, which will give a clear idea about how the economical policy would be uh, framing from here, because the rate cuts would be there definitely in 2026. And second would be the tariff judgment that will be coming today. So maybe we can see some surprise over there. So I think from the level perspective, we are expecting a slight pullback to the level of 43.80 for international gold, and silver should take the support at $72. So better avoid taking long position at current level. After some settlement, or we can say some stagnancy, we can re-enter again. But timing, Friday data is going to be more important for next outlook.
So the data is going to be very important, and 4380, that's the level, that downside level that we are watching for gold, and $72, that is where we could see support for silver. That's the word coming from Mr. Kedia. Now, Mr. Kedia, talking about silver with a possible 10% silver correction towards that $60, in fact, mark, that would be driven by rebalancing. Is this the ideal dip for Indian investors, or should they wait for some more consolidation in, say, mid of 2026?
See, I think one should wait, because already the rally has been superb rally in precious metal. In October month, we have seen 18% fall in silver prices. So I'm expecting at least 25, 28% correction in silver. It should settle down to the level of, let's say, 160, 170 level on domestic side. One more thing is rupee weakness, because consistently rupee weakness has been there. Because of that, also the fall what we can see in international market would not be replica in domestic market because of rupee weakness. But then also the fresh level to enter could be around 160, 170. I would prefer to go with the SIP. Generally, we know SIP full form is systematic investment plan, but in case of silver, it's silver investment plan. So go with a silver SIP, so that in next 6 months you will be at least getting the better pricing, not from the current year, but I think some averaging would be quite better. So go with a SIP plan. We have ETF, we have multi-asset. So go with them, but wait for at least couple of months. Once the prices should correct or time correction should be there, then it would be more attractive rather than adding silver in FOMO, what we are seeing right now.
Fall into the FOMO for silver. That's the word coming in. But, shifting focus from the precious metal space to industrial metals, Mr. Kedia, with copper targeting that $13,500 and higher weight for industrial metals, does this signal a global institutional rotation towards pro-growth assets? What are your thoughts over there?
So, Kanika, generally, when we talk about the commodity super cycle, generally it starts from the energy market, then precious metal, then industrial metal. Industrial metal need a proper we can say ecosystem, like interest rate should come down, inflation should be lower. And up till now, we have seen US inflation around 2.7, interest rates are coming down, which is a perfect environment for base metal to go up, because industrial demand should pick up. And in case of copper, there are two things. One, copper is a replica of silver. When we go with a silver copper ratio, that suggests either silver should come down or copper should go up. So this gain, what we have seen in last couple of months, was in line of expectation, but it was a very furious rally. So maybe we can see some consolidation to the level of 1150 to 1200, because next month Chinese Lunar New Year would be there, and higher prices will just make a buyer to be slightly more reluctant to buy at current level. So maybe some consolidation or some correction would be possible ahead of Chinese New Year. But overall, this year we may see a level like 14,500, 15,000 on LME, because of consistent supply shortage been there, and the new capex is not at all building on the supply side. So I'm more bullish on copper, zinc, and aluminum, these three commodities for 2026, rather than going more bullish on bullion.
So that's the view on bullions. Thank you so much, Mr. Kedia, for your time today and sharing the outlook as far as all of these commodities, metals, and precious metals, and also agriculture. Thank you so much for joining us. Well, with that, time for our very special segment, Did You Know? Now, the commodity markets, they are one of the oldest markets in human history. The first recorded organized trading of futures or futures-like contracts was reported from Japan. Now, the 17th century feudal landlords or samurals, they stored surplus rice in warehouses and in cities and sold them by issuing rice tickets. Now, these rice tickets were commitments for delivery of a certain quantity of rice at a future date at a specified price, thereby locking in prices and reducing risks. Now, the holder of these rice tickets could sell these tickets on the Dolma Rice Exchange that's near Osaka if they did not wish to take delivery.